Welcome back to BullionIQ, the channel where we don't chase hype, we follow the data. If you're new here, this is where finance meets reality, where we look beyond price candles and into what the smart money is actually doing. While most people are glued to 5-minute charts, the real story is unfolding deep inside the plumbing of the XRP ledger, and what is happening right now should have your full attention. Let me start with this question. What if I told you that more than $1 billion worth of XRP has quietly disappeared from the public market in just a few weeks? Not sold, not dumped, simply removed. While retail traders argue over whether $2 is resistance or support, something far more important is taking place behind the scenes. Liquidity is vanishing, and history tells us that when liquidity disappears, price eventually has no choice but to react. Since the very first days of 2026, over 570 million XRP has been pulled off major exchanges and moved into private custody. That is not normal behavior. This isn't random retail panic, and it's definitely not profit-taking. This is a coordinated drain of available supply, and it is changing the structure of the XRP market in real time. The ledger doesn't lie, and the ledger is telling a very clear story. Normally, when an asset reaches a psychological level like $2, we expect to see selling pressure. Traders take profits. Coins flow back onto exchanges. Liquidity increases. But that's not what's happening here. Instead, exchange reserves are falling off a cliff, while the price refuses to break down. That divergence is extremely important. It tells us that sellers are drying up, not increasing. Think about this for a moment. Price is holding steady, yet the number of XRP available to buy on exchanges is collapsing to levels we haven't seen in years. That is the textbook definition of a supply squeeze forming beneath the surface. It's like compressing a spring tighter and tighter while pretending nothing is happening. What makes this even more interesting is the speed. This kind of capital movement usually takes months. We are seeing it happen in weeks. That tells us the buyers involved are not looking for a quick flip. They are not traders. They are positioning for something much bigger. When assets leave exchanges this fast, it usually means one thing: long-term conviction. The data shows XRP entering 2026 with a completely different identity. This is no longer just a speculative token being passed around by retail. It is being treated like infrastructure, like a strategic asset, the type of asset you secure and lock away, not one you keep sitting on an exchange waiting to trade. And here's the key insight most people are missing. This is not just whales moving coins between wallets. This is a billion-dollar vacuum that is draining the order books of the largest exchanges on the planet. Binance, Coinbase, Bybit, all seeing reserves fall at the same time. That kind of synchronized outflow doesn't happen by accident. When you look at where the XRP is going, the picture becomes even clearer. Coins are moving directly from hot exchange wallets into cold storage, not into other trading platforms, not into DeFi pools, into deep storage, dormant, removed from circulation. That means fewer coins available for short sellers, fewer coins available for panic selling, and far less liquidity during volatility. If demand continues to rise while liquid supply continues to vanish, then this calm price action we are seeing right now is misleading. It's not stability, it's compression. Markets don't stay compressed forever. They eventually resolve, and when supply is tight, resolution tends to be violent. This is why institutional behavior matters more than headlines. Institutions don't chase candles. They build positions quietly, and they secure assets long before the crowd understands why. The current drain suggests that big money isn't preparing for a local top. They're preparing for scarcity. And this is exactly why we focus on ledger data here at BullionIQ. Anyone can look at a chart. Very few people look at liquidity flows, wallet behavior, and exchange reserves. That's where the truth lives. Price follows liquidity, not the other way around. So as we move forward in this breakdown, keep this in mind. What you are witnessing right now is not noise. It is not hype. It is a structural shift, a slow but relentless removal of XRP from public access. And once that supply is gone, no amount of wishing will bring it back at lower prices. In most market cycles, accumulation is one-sided. Either whales buy while retail sells, or retail chases price while institutions wait patiently. What we are seeing in early 2026 is something very rare. Both sides of the market are buying at the same time, and they are doing it with conviction. On one end of the spectrum, we have whale wallets. These are addresses holding over 10 million XRP, some even far more. Historically, these wallets tend to accumulate quietly during fear and distribute into strength. But right now, instead of distributing near the $2 level, these wallets are expanding their positions. On-chain data shows whale holdings increasing by more than 15% since January 1st. That is not defensive behavior. That is aggressive positioning. At the same time, something equally important is happening on the other end of the spectrum. Smaller wallets holding under 10,000 XRP are also increasing their balances. This tells us retail is not panic selling. They are not providing exit liquidity like they did in previous cycles. Instead, they are holding and in many cases adding. This creates a dual-engine accumulation model where supply is being removed from exchanges from both directions simultaneously. When both whales and retail refuse to sell, liquidity doesn't just dry up, it hardens. This is why the $2 price level has become so resilient. Every dip is being absorbed almost instantly, not because of hype, but because there simply aren't enough coins available to push price lower without triggering strong demand. This kind of alignment creates a massive problem for anyone betting on a deep pullback. Normally, a correction happens because one side blinks. Either whales take profit or retail panics. Right now, neither side is blinking. Instead, coins are being locked away into cold storage, and once coins enter cold storage, they tend to stay there for a long time. Wallet age data confirms this. The XRP leaving exchanges is not cycling back quickly. Coin age is trending upward, which tells us these tokens are becoming dormant. This means they are not being prepared for sale. They are being prepared for long-term holding. That is a major shift from previous years, where XRP often rotated quickly between wallets. In past cycles, retail holders were often the liquidity source for whales to exit. In 2026, that relationship has flipped. Retail is holding just as tightly as institutions. This changes the entire market dynamic. Without weak hands, volatility becomes compressed, and compressed volatility eventually explodes. Now let's layer in institutional behavior, because this is where the structural support comes from. We are not just seeing on-chain accumulation, we are seeing institutional-grade demand through regulated products. Over $1.3 billion has flowed into XRP-focused spot products and ETFs since the start of the year. This is not speculative money. This is mandated capital. Institutional money behaves very differently from retail money. It does not panic sell on a 10% dip. It does not chase breakouts impulsively. It is allocated for long-term exposure, often locked behind compliance rules and custody agreements. Once XRP enters these vehicles, it is effectively removed from daily price discovery. This creates what analysts call a black hole effect. Tokens go in, but they do not come back out easily. When you combine this with exchange outflows, the result is a rapidly shrinking liquid float. That means fewer coins available for trading, fewer coins available for shorts, and far more sensitivity to buy pressure. Another key detail many people miss is where this demand is coming from. Institutions are not buying XRP just because of price. They are positioning for utility. The XRP ledger is increasingly being used as a settlement layer. Transaction volume on-chain is reaching all-time highs, even while exchange trading volume remains relatively flat. That tells us XRP is being used, not just traded. Every transaction that settles on the ledger creates real demand. And institutions that rely on that infrastructure don't just want access today. They want guaranteed access tomorrow. That is why they are holding XRP, not renting it. This is the foundation of the current accumulation cycle. It is not driven by hype or social media narratives. It is driven by necessity. If XRP is going to be part of the future financial plumbing, then owning it becomes strategic, not optional. As more XRP gets locked away into institutional custody, ETFs, and cold storage, the remaining supply on exchanges becomes increasingly fragile. Even a moderate increase in demand could trigger outsized price movement simply because there are not enough sellers left to absorb it. This is why short sellers are in a dangerous position right now. Exchange data shows outflows outpacing inflows by a ratio of 4 to 1. For every one XRP deposited, 4 are withdrawn. That is not a healthy environment for shorts. That is a supply sink forming in real time. It's important to look at the other side of the equation, the risks and potential counterbalances to this supply squeeze. No analysis is complete without acknowledging what could slow or reverse a rally, and XRP's history gives us plenty to study. One key factor is the legacy wallets. These are accounts that have been dormant for years, sometimes holding hundreds of millions of XRP. While the current trend shows rapid accumulation and removal from exchanges, if even a small portion of these legacy holders decides to sell, it could temporarily offset the supply drain we've been tracking. On-chain data has already started showing a slight uptick in legacy wallet activity. Around 12% of dormant tokens have begun moving in early January. That's a number we can't ignore because historically, when these wallets activate, short-term retracements or consolidations often follow. This is why risk management is so critical. Even if institutional and retail accumulation is strong, the market can react violently if dormant holders suddenly decide $2 is their exit point. It's not about doubting the bullish thesis, it's about understanding that markets are never one-sided. Short-term corrections don't negate long-term trends, but they can shake out weaker hands and create volatility spikes that catch unprepared traders off guard. Technical indicators also deserve attention. Some analysts are pointing to an emerging death cross on shorter time frames, a situation where the short-term moving average crosses below the long-term moving average. While this is not necessarily a prediction of massive price drops, it can signal temporary hesitation in momentum. A death cross combined with activated legacy wallets could result in a pullback toward the $125, $1.50 range, even as the broader accumulation thesis remains intact. The takeaway here is that even in a structural supply squeeze, technical resistance and historical behaviors create natural pauses. Now, let's talk about the psychology of the market. Right now, we're seeing a rare alignment between institutional smart money and diamond-handed retail. But psychology can shift quickly. FOMO, profit-taking, or fear triggered by external events can temporarily interrupt the perfect supply-demand equation. That's why it's important to focus on the data itself: ledger flows, cold storage trends, exchange outflows, not just price action. Price reacts to liquidity, and liquidity is what we are tracking in real time. The rate of exchange outflows is staggering. Over 570 million XRP has been withdrawn in just 3 weeks, representing roughly $114 billion. This means liquid supply is dropping faster than almost any comparable period in the past 8 years. As the available float tightens, even minor buy pressure can cause significant price jumps. But it's also important to remember that thin liquidity can amplify both upward and downward moves. A single large sell order, particularly from a newly activated legacy wallet, could temporarily shock the market. Institutional behavior mitigates some of that risk. Most of the $1.3 billion inflow into XRP spot ETFs and corporate holdings is sticky money. These are positions governed by long-term mandates. They do not panic during minor dips, and they rarely exit at minor support levels. This provides a structural backbone to the current accumulation cycle. Retail may still react emotionally, but institutions are acting strategically, which creates a buffer against short-term volatility. Another point to note is the growing use of XRP as a real settlement layer. On-chain transaction volume is rising while exchange trading remains flat. This indicates that a portion of demand isn't speculative at all, it is operational. Banks and payment providers are buying and holding XRP to ensure they have liquidity for cross-border transactions. This functional demand adds another layer of support because coins used in this way are effectively removed from circulation until they are needed. We also need to consider the supply squeeze math. With withdrawals outpacing deposits at a 4:1 ratio, the liquid XRP available for trading is disappearing fast. Fewer coins on exchanges mean that even moderate buying pressure can trigger a sharper than expected price response. In practical terms, this means that once the price begins moving upward, there may be very little resistance until we hit significantly higher targets. The market can become almost mechanical in this phase, responding to liquidity constraints more than to external news or sentiment. Finally, it's essential to frame this in terms of long-term positioning versus short-term trading. Many retail traders are still thinking in terms of daily gains and losses. Institutions are thinking in terms of years, and they are securing assets that will form the foundation of financial networks in the near future. When billions of dollars move into custody accounts and ETFs, we aren't talking about volatility, we're talking about structural change. To sum up, this phase of XRP accumulation is extraordinary, but it's not without risks. Legacy wallet activity, short-term technical signals, and market psychology can create temporary pauses or retracements. Yet the underlying data shows a profound reduction in liquid supply, simultaneous accumulation across wallet sizes, and sticky institutional demand. These factors collectively create a unique environment that we rarely see in crypto markets, one where supply constraints are as meaningful as price itself. It's time to dive deeper into the mechanics of supply and demand. This is where the real market dynamics reveal themselves. Exchanges are no longer just places where people trade. Right now, they are the battleground for liquidity, and liquidity is the lifeblood of price discovery. Without it, even small buy orders can have a massive impact. Take a look at the current exchange balances. XRP reserves are at 8-year lows, which is not something that happens overnight. When the liquid float is this thin, the market becomes highly sensitive. Even modest buying pressure can trigger disproportionate upward price moves. Think of it like trying to push water through a narrowing pipe. A little force creates a sudden surge. This is exactly what a liquidity squeeze looks like in practice. Cold storage is the key driver here. Over 570 million XRP have moved from active exchange wallets into private custody in just 3 weeks. That is a huge portion of the tradable supply. These coins aren't moving back to exchanges anytime soon. Once they enter cold wallets, they are effectively removed from circulation, creating a vacuum that the market can't easily fill. At the same time, institutional inflows into ETFs and other regulated vehicles are acting like another layer of scarcity. The $1.3 billion in new capital isn't just parked on the sidelines. It's effectively locked away, inaccessible for daily trading. The result is a multi-tiered supply reduction. Coins are disappearing from exchanges, from hot wallets, and into custody products that are intended to stay put. This combination is rare and powerful. Now combine this with the dual-engine accumulation we discussed earlier. Both retail and whales are buying simultaneously. Normally, retail acts as a counterbalance to whales, either providing liquidity for exits or panic selling into rallies. That feedback loop is broken. With everyone moving in the same direction, accumulating, there is almost no natural seller left in the market. This is why the $2 floor has become unusually resilient. Price isn't just holding because of support levels. It's holding because there aren't enough coins available to push it down. What happens in such a scenario? Even a relatively small increase in buy pressure can trigger outsized moves. If just a few large orders hit the exchanges, the thin sell side can't absorb them, and price can spike rapidly. This is why understanding liquidity is more important than watching candle charts. Price moves when supply and demand collide, and right now the collision zone is extremely tight. Another factor is order book depth. Exchange order books are getting extremely thin. The ratio of outflows to inflows has been 4.1 for the past 3 weeks. For every one XRP deposited, 4 are being withdrawn. This creates a precarious situation where liquidity is disappearing faster than price can adjust. The market is effectively being compressed, and compressed markets are notorious for explosive breakouts. On top of this, the on-chain volume of XRP is growing steadily. Transaction activity on the ledger is hitting all-time highs, particularly for cross-border settlement. This means that the coins are not just being held, they're being used for real economic activity. That adds another layer of demand that is entirely independent of speculation. Institutions need these coins to operate, and they hold them to ensure operational continuity. That demand further reinforces scarcity. Let's not forget the role of FOMO. As supply tightens and coins vanish from exchanges, retail traders start noticing the reduced availability. Fear of missing out intensifies, creating an additional demand shock. This is the classic squeeze scenario. Supply is gone, demand is rising, and price moves fast as a result. It's also important to consider the mathematics of scarcity. Removing 570 million XRP from liquid supply is not incremental, it's transformative. This is a level of depletion that hasn't been seen since the pre-2017 accumulation phase. When demand exceeds available supply by a significant ratio, every new buyer faces higher costs. The more coins disappear into custody, the higher the price must climb to balance the market. The combined effect of exchange outflows, cold storage, ETF inflows, and on-chain operational demand creates a feedback loop. Liquidity shrinks, price moves up, more coins get pulled into private custody, and liquidity shrinks further. This loop can accelerate quickly, which is why even moderate buy pressure can trigger dramatic upward movements. However, there is a caveat. While this liquidity dynamic sets the stage for large moves, temporary technical resistance or activation of legacy wallets can still cause short-term pauses or corrections. That is why professional traders look at liquidity metrics alongside technical charts. Ignoring one or the other can lead to being blindsided. In short, we are approaching a point where the market is finally balanced between extreme scarcity and rising demand. Once the next wave of buying hits, the combination of thin order books, depleted exchange reserves, and institutional accumulation could result in a sharp vertical price response. This is not speculation. It's the predictable outcome of a liquidity crisis. Liquidity and supply-demand mechanics. It's time to connect all the dots and look at what this could mean for XRP's price in 2026. When supply is being drained at this scale, the market doesn't move sideways for long. The path of least resistance is upward because there aren't enough coins available on exchanges to counter buying pressure. This is the final phase of the supply squeeze, and understanding it gives you a blueprint for what could come next. Let's start with Fibonacci extensions, a tool used by traders to anticipate potential price targets based on prior price moves. By overlaying the current exchange drain and accumulation cycle on the previous 2017 breakout, the data suggests a clear trajectory. The first major extension, corresponding to the 1.618 Fibonacci level, sits just below $6. This is not guesswork, it's a mathematical projection based on both historical cycles and the current liquidity vacuum. When coins are disappearing faster than they can be bought, price has to adjust, and Fibonacci levels help identify where that adjustment could pause or reverse. Next, let's consider the Elliott wave structure. According to the wave count, XRP is currently in the middle of a wave 3 move, which is traditionally the strongest and most impulsive phase of any market cycle. Wave 3 is where the majority of participants finally recognize the scarcity in the market and begin chasing the move, often creating rapid vertical price action. The accumulation we've been tracking since January 1st forms the base of this wave. Once Wave 3 reaches its peak, minor corrections in Wave 4 may occur, but the trend remains bullish as long as liquidity remains tight. Now, here's the crucial insight. Both Fibonacci projections and Elliott wave analysis point to the same conclusion. We are entering a phase where price could spike sharply, even if the world is unaware. This is a rare alignment between technical structures and on-chain fundamentals. Historically, when exchange reserves hit multi-year lows during a wave 3 phase, price has often experienced vertical moves that leave latecomers chasing a rally. At the same time, it's essential to consider strategic navigation. The liquidity squeeze creates opportunity, but also risk. With so few XRP available on exchanges, relying on a single platform could leave you locked out during sudden spikes. That's why professional investors maintain multiple KYC-verified accounts across different exchanges. If one platform experiences a delay, technical issue, or liquidity crunch, you can still execute trades elsewhere. This is how institutions operate, and following a similar strategy is crucial for anyone wanting to participate in such a market. Risk management is also critical. While supply is low and upward pressure is strong, legacy wallets and technical resistance could still create temporary pullbacks. Always position size carefully, avoid over-leveraging, and focus on coins you are willing to hold through minor volatility. The goal isn't short-term gains. It's positioning for a structural move based on liquidity dynamics. Let's revisit the supply-demand math one last time. Over 570 million XRP have left exchanges in just a few weeks. ETF inflows add another $1.3 billion of locked capital. Retail and whale wallets are both accumulating. The remaining liquid float is shrinking rapidly. When you compare projected buy orders from new entrants to the coins actually available for trade, the gap is massive. This creates what we call a squeeze zone, where price must adjust upward to find sellers. The implications are clear. If institutional buying continues at the current pace and retail maintains diamond-handed behavior, the next major leg of the XRP move could happen quickly, potentially hitting targets in the high single digits per token. The combination of a depleted float, sticky institutional capital, and increasing on-chain utility creates a scenario where supply cannot keep up with demand. This is not hypothetical. The numbers tell the story. But here's where discipline comes in. Just because the setup is bullish doesn't mean you should act recklessly. Use multiple platforms, monitor exchange reserves, and watch cold storage inflows. These are the signals that indicate when the market is truly ready for the next leg. Avoid chasing price once the move starts. Early positioning before liquidity disappears is key. Finally, remember that XRP is no longer just a speculative asset. With banks, payment providers, and institutional products integrating the ledger, XRP is becoming a cornerstone of the next generation financial infrastructure. This structural shift is what differentiates the current market phase from previous cycles. The billion-dollar exchange drain, combined with coordinated accumulation, signals that we are not waiting for a breakout. The breakout is already being engineered by liquidity itself. In conclusion, 2026 is shaping up to be a transformative year for XRP. The combination of supply compression, institutional participation, retail alignment, and on-chain usage is creating a rare market environment. Price targets from Fibonacci extensions, Elliott wave projections, and liquidity models all point to a potential surge towards $6 or higher during this cycle. Strategic positioning, risk management, and awareness of liquidity flows are your tools to navigate this environment successfully. At BullionIQ, our mission is to give you the insight, data, and perspective to understand these structural shifts so you're not reacting to hype. You're anticipating the next move. Keep tracking cold storage trends, ETF inflows, and exchange liquidity because the next breakout isn't coming. It's being quietly built beneath the surface of the market, and only those prepared for it will fully benefit.